My name is Ariel Brookhartz. I've got Scott Parry from Crown Money here as well. I'm the general manager at Motion Property. We have a strong focus here at Motion to keep our clients informed and educated in all things related to investment property. In fact, we recently held a webinar with many of you in attendance with Sean White. He gave us a great update in relation to the state of the market and what to expect in the coming 18 months. So hopefully that was informative. This time around, we've invited Scott Parry, founder of Crown Money, to share some practical tips that you can use to save significant amount of money and time while improving your financial position. I understand that a few of us are experiencing the pinch with the constant rate rises that we are experiencing. So hopefully there'll be some good news at 2:30 today, Scott, or alternatively, there might be some bad news at 2:30. Scott is a financial coach with over 20 years of experience. He's helped thousands of clients achieve their financial goals by implementing strategies that get them out of debt faster. If you have any questions throughout the presentation, you'll see a question and answer box that you can fill in. We will attend to those questions at the end of the presentation. And without further ado, we can start the presentation. So over to you, Scott.
Thank you, Ariel. G'day, guys. Appreciate making the time. I'm going to give you some bang for buck. It's something where 20 years worth of horror stories and nightmares, but also success stories from over 6,500 Australians that I've worked with. I just want to tell you what I've learned about money, how we can actually get your income working a little bit harder for you, but more importantly, the two things that everyone wants to know is, Scott, how can you make me more money, or how can you save me more money? We're going to cover off on both those topics today. So first things first, why should you listen to me? It's a great question you should be asking yourself. And so where it sits is, my average client, when they're working with us, saves 21% of their salary compared to 6.9%. So what does that mean? That's a savings rate. You probably wouldn't have heard of this before. I measure every one of my clients' savings rate like a personal trainer will measure someone's body weight. And so what percentage of your income you keep is everything to me. How much you earn is irrelevant. It's what you keep of what you earn. And so from that perspective, if you're earning $100,000 a year, my average client's saving 21,000 of that. Whereas the average Australian is only saving 6,900 of that. So how do we increase your savings rate? We're going to run through that. In terms of debt reduction, every 23 days, I get to pick up my phone and say, congratulations, Mary, you just paid your house off. It's a phenomenal phone call to be able to make every month. Some people cry, some people laugh, some people giggle, some people don't believe me. And so it's really about how do we actually own our portfolio come retirement, so it spits out that passive income stream that we've all been waiting for and dreaming of, because that's what allows you to have that lifestyle in retirement. It's not your equity, it's the income that's coming off that asset base. And so if I can get that asset base debt free by that period in time, that mainly includes your home as well, that means you've got more income in retirement. You don't have to sell down the assets. We can actually have them sit there, grow, compound, and have that income stream come off it. So my average client's paying $30,000 a year off their principal, and the average bear in Australia is just doing over $10,000 a year. So 300% better results. Same income, same debt level, just the right structure, the right strategies. And the reality is, no one's teaching us about money, not in school, high school, university. And so guess where you learned money from? Your parents. And if they're average at money management, you're probably going to pick up some of those average habits there. So I'm just going to tell you the best practices over 6,500 people, 20 years of experience, what's worked best for people, how's it worked. And by the end of this next 30 minutes, you're going to walk away with some implementable actionable steps. So a little bit of press over the last 20 years, TV stations, newspapers, radio, all asking me, what are you doing differently, mate? How is this working? Why is this working? This strategy I'm about to run through with you has helped me personally buy over 10 investment properties. That's in my own personal name without any sort of friends, family jumping in. And since 2003, I've created more than $50 million in equity in clients' homes. And so from that perspective, what I'm about to run through with you is tried, proven, and tested. It's not something I've banged up in the garage on a weekend and thought, Ariel, let me at him. I've got some gold to dish out. So it's all really about making sure that you've got the right structures in place to save you from yourself, but more importantly, you're measuring everything. And so I'm a big believer in what gets measured gets managed. And if you're not measuring it, and I don't know too many people who can answer these questions of what's your surplus cash flow position every month, what's your equity position every month, what's your borrowing capacity this month, what's your savings rate this month, what's your net worth this month. Not many people can answer that. Everyone can answer what their body weight is, but why can't anyone tell me what their financial weight is? And so today's really about giving you the data and the ability to be able to track all of that, so you know whether or not you are ahead of the curve. And I can tell you exactly what the day is that your home's going to be paid off, as well as exactly what day your super or your life savings will run out in retirement. It's so many people are getting to retirement like, do I have enough money? And so I've got all the calculators where I can do all your figures for you and say, based on what you've currently got now, if we extrapolate that out, your life savings will last you to 92 years of age. And that's a pretty freeing mindset to know, oh, I'm good. I can actually spend until the age of 92. And we all know we're not too active at 92. And so that's really what I want to try and give you, is give you your numbers, give you that data to give that peace of mind financially. A lot of good reviews as well. I mean, my families are paying 112,000 a year off their mortgage. They're not earning huge amounts of money. They're just getting their money working for them. Another client, 87,000 a year off their mortgage, 61,000 a year off their mortgage. These are the clients. Remember, my average is 30,000. My average client does 30,000. It means I've got a lot of clients doing more than that. I've got a few clients doing less than that. But from where we sit is we just want to improve your financial position, and we just have the results of being able to increase it by 300% based on just changing your structures and getting your income working a little bit harder for you. So what do I bring to the table? We're going to talk about cash flow structures. We're going to find you a cheaper loan. I'm going to set you some debt and cash flow goals. And then from there, help you reduce your fixed expenses. Like, we help you audit all your expenses as well as reduce those expenses. Remember, you just want to know, Scott, how can you make me money, or how can you save me money? And so we're trying to be working on both sides of that fence. Review your spending habits, strategies to increase your income. This is critical. Like, no one talks about this enough. Everyone's always looking at saving money. One of the easiest, lowest hanging fruit is to actually just ask for a pay rise. So we've got scripts on what you need to be saying to your employer or your boss about a pay rise, like what to say, how to approach it, a full playbook on that. We want to help get you investment fit. Like, at the end of the day, the quicker you can continue to build your property empire, the quicker you've got that compound interest working for you and allowing your portfolio to grow. And my biggest regret is, with my 10 plus investment properties, I just wish I had bought them all at the start of my investing career rather than sort of one every few years, because those ones I've bought lately haven't grown as much as those ones I bought at the start. And the entry cost was so much cheaper 10, 20 years ago than what it is today. Increasing your financial IQ, very, very vital, just to grow your financial IQ, because, as I said, we're not sort of being taught any of this in school. And so to be able to pass that on to your kids and family as well is very vital. And if your borrowing capacity is maxed out, i.e. you cannot borrow anymore, I highly suggest you speak to your employer about looking at a salary sacrifice, so that you're diversifying your pre-tax income into shares as well as property. I'm a big believer in both. Obviously, property's got great leverage, superannuation doesn't, but what it does have is a really good tax environment, as well as the ability to compound out over those next 20, 30, 40 years of your working career. So where are we sitting in 2023? Rates are going up, rents are going up. Like rents, I'm going to show you all the data here. As an investor, you guys have got these rate rises coming through. You pass them down. That's what we do as landlords. We just pass them down to the tenant. And unfortunately, they've got to wear a big sort of chunk of that. And so these rents have gone up by 10% plus. I continue to see that. There's a huge undersupply. And so I think your rents are going to continue to go up by another 10%. Rates are going to increase another 1 to 2 times this year. And so what that means is I'm very confident we'll have a rate rise today. I believe that it could be anywhere up to 0.5, but it's something where that's another 2 rate rises between now and the end of the year. And then hopefully they sort of the dust starts to settle, and then they can see how much sort of this has an effect on inflation. But unfortunately, what a lot of people don't take into account is when the rates rise for you and I as investors, they also rise for businesses. And these businesses take on large amounts of debt. They have obviously all their income being generated pre-recession. And all of a sudden now their income or their revenue is not as high, but their business debts have gone up in terms of repayments. That's why you're seeing a lot of companies fold or go into involuntary administration or bankruptcy. And so with that comes unemployment, and with unemployment comes a lower inflation rate. So that's what sort of lays ahead, unfortunately. But those days of cheap money, 2%, 3% rates are gone forever. Like, we'll never see them again. This is the new normal. This is exactly where rates will be for the next 2, 3, 4, 5 years. People thinking that rates going to start dropping again. No, maybe once, but not sort of back to where we've come from. Interestingly enough, Melbourne is the 8th week in a row where we've actually had a clearance rate above 70%. This time last year, that clearance rate was 58%. So it's a big contrast to last year. A lot of people say, well, is this the bottom? If we sort of onwards and upwards? I'm not so sure. I feel a few more rate rises are going to change things. Some people are saying it's a dead cat bounce, where it sort of bounced, but then will sort of continue to slide. Bottom line here is it doesn't matter what the actual property market's doing unless it's the day you're selling. That's the only day the property price matters. The other day it's going to go up, it's going to go down, but the rents are continuing to increase, and that's the most important thing for us as investors. And I'm a buy hold guy, just put hands on the table. And so the day I sell is the day that the price matters. What happens in between now and then is pretty irrelevant for me. This is a property clock from the guys at Performance Property here. This is telling you where things sit. Houses are on the left, and so you can see the hour hands here, and you can really start to look at Melbourne here, coming up to pretty close to the I would say, market starts to consider a downturn there, and that's over a period there. You're going to get around about 7% per annum growth compounded over a 10-year period for Melbourne. But if you look at the units over off to the right-hand side here, you can see Melbourne units are still in the buy momentum stage, or the holds. They're coming right up to the hold stage. So that's why I said, if you're in a position where you've got any sort of investment stock in Melbourne, it's definitely in the hold stage for both the houses and units. And you can see the units there probably forecast to be earning between 6 to 6.9% per annum growth over a 10-year period there. So really fascinating how that works. So that boom and bust is sitting there. This is just a zoomed in for Melbourne units here. You can see that certainly in the hold pattern. I wouldn't be selling at this point in time because you're obviously getting to that point here where that's where the sell buttons are. But from where we sit, it's just we've come out of the buy momentum, we're moving into the hold, and as a result of that, a few more rate rises are going to slow things down a little bit more, and then the dust will settle. And then that first rate reduction is probably my trigger where I start sort of putting my buying cap on again. And so I'm just waiting for that first rate reduction from the RBA. I think it probably could be 2024, and that's when I'll start to say, okay, now we're coming to the shopping market. It's going to be a lot of blood on the streets by then. Don't worry about that. 800,000 mortgages coming out of fixed rates where they were fixed for 2%, 3% going to 6%. And those guys are going to struggle. They haven't stashed away all the cash that they've been saving with their lower rate. And they're going to really feel the hit there. And so there's going to be a lot of those put their properties on the market there. So that supply will take a bit of time to soak up. This is really interesting here as well. You can see the weekly change, 0.1% growth in Melbourne, the monthly change, 0.9% growth in Melbourne. So there has been some growth over the last 30 days, which is, I'm quite surprised by it, pleasantly surprised. And for the year to date, 2023, Melbourne hasn't lost anything, but over a 12-month period, it's lost about 7.5%. So over a 12-month period, you're down 7.5%. Previous to that, you're only at about break even from where we sat in 2023. So really positive signs, surprisingly positive, but that's just going to mean more rate rises to try and quash that there. So this is a rental snapshot here. We're looking at Melbourne, median rent 543. That there has increased by 1.4% for the month, 12.2% increase in rent over a 12-month period. I see close to double-digit growth again for rentals just due to the undersupply. So this is really good news for us as investors. We can continue to increase our rents. This is a yield versus interest rates. And so you can see here the cash rate where it bottomed, everyone was sort of fixing in here. Now that's stepping up, that light green arrow. You can actually start to see the yields in units really, really strong and will continue to grow. And so back in the day, a year or two ago, remember how everything was positive cash flow. It was this freakish time where the rent covered the mortgage. It was like, wow, this is what it feels like to have an investment property in the US. It was phenomenal. Everything you bought from day one was positive cash flow. Those days are obviously sliding. Those rates are going up. And therefore, we're usually now back into the traditional movement of, if you've obviously bought the property recently, the rent is not enough to cover the mortgage. So we're topping it up by $100 or $200 per week. But from there, we had a really good run where the rent was covering the mortgage for those new purchases there. So 3 stages of property investing. I just want to walk you through this journey. So the first is buy and hold. So that's where you buy a property and you sit on it and you hold it. What I've learned from 6,500 people over 20 years is the magical secret recipe to be able to retire with more money than you can spend before you pass away is to pay off your house and acquire 2 or 3 investment properties before you retire. That's it. That's the secret sauce. But pay your house off and buy 2 investment properties before you retire. So if we're in 2023 now, we buy 1 investment property. In 2033, if that was a $600,000 purchase, I believe that probably be closer to 900,000. And in 2043, it's going to be close to 1.3 million. And so just off that 1 property purchase, we've been able to glean $760,000 in profit. You're going to have capital gains tax, of course. And so if you sell that in 20 years time, that's another 750,000 take capital gains tax in your life savings. Or you've got that passive income coming off that because it's going to be positive cash flow because those rents are increasing. 10 years from now, that's going to be positive cash flow. The rent's $700 per week. Your repayments are $623 per week. It's washing its own face. There's no better place to be in property than for the property to wash its own face and pay you to own it. It does take time for it to get to that point. So if you are a passive investor, you just want to do the buy hold strategy, the recipe here, pay your house off and acquire 2 or 3 investment properties before you retire. So 1 every 10 years, for example, and that's all you've got to do. And you're gonna be very, very comfortable in retirement. Obviously, you've got your super there as well. The second stage of property investing is to renovate. Now, probably not the greatest of markets to be renovating with the cost of materials plus labor shortages. It's very dicey. And I really like renovating when the land prices are going up. If the land prices aren't going up, then you sort of got that downside risk of you've lost capital in terms of the value of that land there. So with a renovation, for every $1 you put in, you want to get $2 back. And so the best and smartest ways to renovate a house are to do the bathrooms, kitchen, landscaping, and painting. All that cosmetic stuff, very low hanging fruit, low risk. That's where you get the biggest upside. So for every $1 you're putting in, getting $2 back. For me, if you're running from the buy hold strategy, most people then advance to the sort of renovate strategy. But for these, at the moment, the renovate strategy is not that attractive for me. Then you've got the third stage of property investing. That's where you're adding value to land. And what does that mean? That means you're buying a block that's subdividable and then you sort of split it into 2 or 3. And as a result of that, you can build 3 units on 1 property as opposed to just having that 1 house. And so this was a development I did. Got the block for $350. It was 800 square meters. Demolished the house, built 3 units on it for $200,000 each. So my total cost was $1 million for the land as well as the actual build. And so I sold them each for $625. There was $1.8 million in sales, $875,000 in profit. That was over the course of around about 24 months. So that's where you advance to buy hold, to renovate, to then these subdivisions. And once again, there's so many moving parts. It looks easy, but it's certainly something where having the expertise of motion to hold your hand every single step of the way, no matter what you're looking at doing, is vital, because to do that yourself, it's just dangerous, and a lot of people come unstuck and undo all their good work there. So I believe now is a really smart time to be setting up what I call investment facilities or master facilities. And what that is, it's really just unlocking the equity in your home. And so if you've got a house worth $750, you owe $500,000 on it, there's $250,000 equity there. And so the banks will allow you to unlock some of that 250,000 to set up as an investment loan or an investment facility. It sits at a zero balance, but it's like a $100,000 limit. And so you're not paying any interest on it at all. It's just sitting there if required. And the reason why now is the best time is because every single time the rates go up, your borrowing capacity goes down. That means you're not going to be able to unlock as much equity as what you could before this rate rise going through today, etc. And so as two more rate rises go through this year, you're not going to be able to unlock as much equity as what you can do today. And so that's why I feel now is a really, really good time, because your borrowing capacity is as strong as it's going to be for the next 12 to 18 months. And so once that master facility or investment facility is set up, it just sits there. It doesn't cost you anything. And if you find investment in the future that you'd like to put down a deposit or stamp duty on, that's where you're using that investment facility to fund those costs. And then you're borrowing 80% of the new purchase price with a new loan at that point in time. So that's something which I highly recommend you guys look at doing. At the same time, we can obviously just restructure everything on your home to make sure that that's on the best deal possible. But those doesn't cost you anything to do that. It just allows you to have that flexibility now when your income can borrow the most it possibly can over the next few years. So these are the numbers on a property purchase for $600,000. Your first year, you're going to have interest costs of about $692 per week. If that's renting for $500 per week, that means that you've got a shortfall around about 17%. I always allow $50 per week for insurances and rates. And so when you're looking at that, it's $250 a week to hold a $600,000 asset. And obviously all that $692 per week is tax deductible. It means you'll get 30 cents back in every dollar you pay in interest, ballpark figure, plus depreciation. And so I just look at it, that's a super, super smart way to leverage $250 per week. For $250 per week, I can have a $600,000 asset. In 10 years, it'll be worth $900,000. And in 20 years, it could be worth $1.3 million. And so I look at that and think that's a really good play to pull $750,000 out in 20 years time to top it up by $250 per week today. And so that is what a $600,000 property looks like. If you're going higher than that, it's obviously the number's going to be a little bit higher, and vice versa if you're going lower. But a lot of people sort of don't feel that they can afford an investment property, but I look at it, go for $250 per week. And that's pre-tax and depreciation. It's could possibly be achievable based on your situation. So how do banks make money? This is fascinating. I'm not too sure if anyone knows this, but your money doesn't sit in your savings account whilst you're waiting to pull it out. I know you're sort of thinking it is. It's not there. So if you have your employer putting $5,000 per pay into your savings account, for example, the bank relends that money out, that $5,000 out instantly. So the minute your salary hits from your employer, hits your savings account, the banks relend the money out to other customers for their credit cards or personal loans or car loans, or even for their own home loan. And so your money doesn't sit in your savings account and wait for you. The bank relends it out and makes 16, 18% on it for credit cards, etc. So let's just take a step back and reverse this. You're giving all your salary to a bank and it's going to your ING account, whatever it may be. That bank pays you 0.01%. That's 50 cents per year for that $5,000. And then they actually make 16% on your money because they've lent it out to Mary for her credit card. So you're giving your salary to a bank, they're paying you 50 cents per year, and then they're making 16% on your $5,000 and paying you 0.01% of that. And so a lot of people are like, whoa, hang on a second. I didn't know that. No one knows that. Banks aren't going to advertise the fact that your money is not in your bank account. It's just numbers on a screen. And so what this comes down to is we really want to be making sure that our money's working as hard as possible for us. And by putting it in your savings account, it is the worst place to keep it. Because if inflation's at 7% and you're getting 0.01%, you're losing 7% a year. So if you've got $10,000 sitting in your savings account, you've literally got $9,300 left by the end of the year due to inflation eating away at that borrowing power there. So please don't put any money in your savings account. It's just literally not working for you in any way, shape or form. So the banks make $45,000 a minute, $2.7 million per hour. Imagine a business doing $2.7 million in profit every hour of every day, 24/7. Incredible business. And that's how they do it. They get your money for free and they relend it to other customers at 16%. It's an insane business model. So how do we sort of counter that? How do we sort of sidestep that and make sure that we're not getting our income working for the bank and more for us. So I'm very big on paying yourself first. And I mentioned this a bit earlier. The number one thing you can do to help you and your family is to actually ask your boss for a pay rise, obviously with context. If you've just got a pay rise this year, you're probably pushing a friendship. But if you haven't had a pay rise for 1 or 2 years, everyone is aware the cost of everything is going up: gas, electricity, groceries, your mortgages, your rents. And so you need to be asking your boss for a pay rise. We've got all the scripts, exactly what to do, how to say it, the full playbook there. So that's what we can help guide you with. The next thing you need to be doing to help yourself is to increase your rents. That's where the guys at Motion are very good, where they're just continually telling you what is possible, what the market's paying out there. And every rate rise, we're just passing it down to those those tenants. And that's unfortunate for them, but like, we shouldn't be holding the can. The other option, of another thing, you should be doing all these. The third thing is to find a cheaper investment loan. Like, I'm blown away by how many people I think paying loyalty tax, where they've got an investment loan 3 years ago, 5 years ago. Two things are going to happen. One is that interest only period is going to expire, and you're going to go into principal and interest, and it's going to blow your cash flow up. And so I would highly recommend you reset that 5-year interest only period right now. At these rates, it's 6.14%. So most people don't know what their rate is, but if you're paying more than 6.14%, and I promise you are, unless you've fixed, then you're paying too much, and your cash flow for your investment property isn't as effective or optimized as it could be. So I'd highly recommend we revisit that, find you cheaper money for your investment property, reset your 5-year interest only period. Because if you can't refinance when that interest only period expires and you go to principal and interest, there is a world of pain. Your repayment's going to go up by $500 to $1,000 per month for your investment property. And so that's on these rates. The best thing is, and this is coming to an end, we can get you $3,000 cash back if you refinance to a cheaper rate today. However, that is finishing. These banks have all pulled out of the cash back. The days of COVID and trying to get business, they're sort of feeling that they don't need to be doing it anymore. And so we must settle that loan by August. Most banks will settle a loan in about 45 days. So if you do your maths, we're in June now, July, August. We've got around about 60 to 75 days. So we must be putting an application in June to qualify for the $3,000 cash back and the 6.14% to be able to give you the most positive outcome cash flow wise for your investment property. So we've got a pay rise, we've increased our rent, we've got a cheaper investment loan, and we've got $3,000 cash back. Like, that's going to fund any shortfalls for, at least if you've got $100 shortfall per week, it's going to fund your shortfall for pretty much the whole year. So the investment property is not costing you anything. And then obviously all the interest is deductible. The other thing there is depreciation schedules. You should be getting one. I'm not too sure if you do have one. If you don't have one, these guys will definitely point you in the right direction, but it's just money that the government's going to give you back, which we'll go through in a little bit more detail now. So there's a PAG withholding variation where you can actually ask for your accountant to give you your tax deduction for your investment property in your pay every month or every week, however you get paid. And so what they do is they say, okay, you pay this amount of tax, but rather than us giving you the lump sum 3, 4, 5, 6 grand at the end of the year, you can get that 3, 4, 5, 6 grand paid every single pay. And so this is a case study here with Joe. He's got a $780,000 investment property. It's rented for $680 per week. And so all of his expenses, his rates, his insurances, maintenance, interest, and property management fees totaling 45 grand. So where we sit here, I just want to show the difference with depreciation and without depreciation. So he's getting the same rental income, 35 grand per year. It's costing him 45 grand in expenses. Without a depreciation schedule done, he's getting no depreciation deduction. With a depreciation schedule done, it's a brand new one. He's getting $15,000 back in tax per year. Obviously, the first year is the greatest, but this was just a brand new property. So his taxation loss here was 9.6 versus 25 grand. He's going to get a tax refund of 9 grand compared to 3 grand. That's 3 times a tax refund. And so what that means is his pay, if he does this PAG withholding, will increase to $358 extra per fortnight in cash flow in his bank account versus only $137 extra in cash flow in his bank account if he doesn't do the depreciation schedule. So that's a $221 a fortnight difference or $221 pay rise per fortnight. So yeah, these guys at Motion are all about depreciation, trying to give you the most amount of tax back and make it as effective as possible. And so that is the benefit there. If you haven't got a depreciation schedule done, the good news is you can get it done now, and they backdate it. So they can actually go back to all the different years they haven't claimed depreciation, and you get a nice big chunk there. So that's something which I'd highly recommend you do on top of those other three things that we just mentioned on the previous slide there. So money management. This is what a good money management system does for you and your peace of mind. You should have 6 months worth of living expenses saved in your loan in your bank account. So that means that no matter what happens, any emergency pops up, you're financially stable. Nothing's going to rock your boat. So 6 months worth of living expenses. If you're spending $5,000 per month in living expenses, you should have 30,000 in cash stashed away as an emergency fund. If you don't have that, then you are at the mercy of emergencies and creating sort of stress in your life there. All bills, rates, and holidays are paid for without having to tap a credit card. Okay, we're paying that with cash. With a money management system in place, your equity is growing by $30,000 per year. Not any capital growth. That's just you're creating $30,000 a year in equity or saving $600 per week. Your salary sacrificing in the super, setting up your retirement. You've got your investments paying a passive income stream to a point where those properties, the rent is more than the actual mortgage, and it's actually helping you pay down your own home loan even faster because there's positive cash flow there. And your home loan will be paid out within 15 years. So all my clients have their house paid off within 15 years. And that's what a money management system does. All those things we just listed there, that's what your world looks like when you have a money management system tracking and measuring everything for you. So one strategy to do that is to bank all your salary into an offset account or into your home loan. With everyone's different, but if you've got an investment, probably definitely bank it into the offset account. That means all your salary is earning you 6%, which is the same as it saving you 6%. All your direct debits to come directly out of that offset account or home loan account. If it is a home loan account, we're the only ones who actually have access to a home loan account, which allows you to set up direct debits out of the home loan account. And then from there, very important, separate your living expenses from your salary. This is critical. This is number one money management. And so many people spend what they have direct access to. If you bank $2,000 a week in salary, guess what you're spending? $2,000 a week. And so where it sits, it's critical to separate your living expenses from your income. And so what we train our clients to do, and what we help set up for them and implement, is that we set up a spending account off to the side. So we've got all our salary going to the home loan or the offset account. And every week, our food, fuel, and fun money goes into a spending account. It's a Visa debit account. Can you see no credit cards here? This is a cash diet. Cash is king. Don't use credit. You just spend more. And so we've got that spending account for all of our food, fuel, and fun. All of our direct debits are taken care of. Everything's on autopilot. We don't have to worry about money anymore. And then anytime you need extra funds, then from there, those monthly, quarterly, annual bills, such as birthdays, Christmas, car rego, holidays, those funds are then transferred into the spending account to pay for those large once-offs. What I do for my clients is we put a 24-hour lag on that monthly, quarterly, annual expense request. And so that just means there's no impulse buys. You're down on Chapel Street thinking, I want a new set of wheels, sneakers, whatever it may be. And you say, I need $600, but that spending account's only got $350 in it. Then 24 hours later, those funds can come across and the impulse is gone. You're not going back to Chapel Street again tomorrow to get sort of all the ordeal is too hard. And so that's where we sort of really accelerate our clients' wealth, is by putting a 24-hour lag on any once-off purchases, just to make sure that you're consciously spending. And the easiest way to consciously spend is to obviously make sure that you don't have direct access to all your equity or income coming from the home loan account. So that's just a hack that we do. It works phenomenally well. And so you're reversing the flow of money. Remember, at the moment, some people are being told to bank into this savings account and pay their home loan. No, the exact opposite. You must flip it. Bank into your home loan and pay your savings account. And by doing that, your loan term is going to go to 15 years compared to 30 years. You'll save 100, 200, 300,000 in interest because you're out of debt in half the time. This is the data we bring to the table for you, is we basically track everything. And this is what you have access to. You can see the savings rate there, 24%. Average in Australia is 6.9%. Exactly what day you're going to pay your house off. Based on your run rate, this is the day you'll pay your house off, which is your debt-free date. This is how much surplus cash flow you've got for the year. This is what your surplus cash flow was for the month. With your old loan, before you met us, you were paying $7,500 off that principal. Now you're doing 21 grand, 3 times better, same income, same debt level. How that works is because of the structure. And just like a personal trainer, when you're being weighed in, you're just more conscious of your weight. We then take a photo of your investment. We see how much of the bank owns of it, how much you own of it, and we sort of continually making sure that you're owning more and more of that investment every single year to create that equity. So you are in ability to go and buy another property to get to that portfolio, to that at least 2 or 3 investments, so you can retire comfortably. We do all your debt-free calculations based on income and expenses. We track everything live. And so this client debt-free in 2032 compared to 2045. And if you've done your maths, you know, when you refinance with a broker, they'll reset your loan term back to a 30-year term. And so every single time you're resetting to 30 years, you're going to the start point of another marathon. And if you're 40 years of age, that means you're in debt till 70. If you're 50 years of age, it means you're in debt till 80. We can't go into retirement with a mortgage, because that means you're going to cannibalize your super fund to pay off your debt. We must exterminate the mortgage before we retire. These are the steps that we run through. So it's a step-by-step plan, checkpoints, dates. This is the first goal. Second goal, saving those buffers, those emergency funds, getting super contributions, borrowing capacities, pre-approvals for properties. We hold your hand every single step of the way and coach you through these steps to be debt-free in under 15 years. And this is how it sort of structures out. We have our house paid off in 10 years. We then pay off that first investment property in the second 10 years. And then if we're still going, we then can pay off that second investment property. And so to own 2 properties debt-free and your own home, man, there is no chance you're gonna be able to spend all your money before you pass away. All of our clients receive, I call it Crown Coins, where they get discounts on everything that they touch. They get 5% off their Coles. This goes through to Dan Murphy's, BWS, everything that you touch, we've got 5 to 10% discounts. The Good Guys, JB Hi-Fi, and that's just basically we're trying to reduce your expenses, right? So I'm trying to create surplus by increasing your income and reducing your expense at the same time. All of our clients get that those Crown Coins as well. And so this is where we sit. We've got rates which are rising. That's going to create headwinds. I think the residential market is undersupplied and likely to get worse over the next 2 to 3 years. So that's going to be those rental yields going to increase. Your rents are going to increase. You should be regularly increasing those rents with the market. And then 2024, that first rate reduction is when my sort of red flag goes, okay, now we're starting to look at what's available in the market and starting to chase yield there. And if you want to work with me, then this is how we can do it. We can do some free financial coaching for you, guidance, scenarios, scripts writing for a pay rise, review all your current finance structures and debts and loans, get you that cash back, get you onto the cheaper money, set up a money management system tailored just for you and your partner, if you've got one, and then also run borrowing capacities and pre-approvals for you. So that is how we can help. Scott@crown.money if you want any of my guidance or expertise. And over to you, Ariel.
Thanks, Scott, and thanks for everyone in attendance. I think it's undervalued, the importance of having help with everything to do with finance. If you want to get fitter or lose weight, you've got a personal trainer. If you want to learn an instrument, you get a coach. But for some reason, people overlook the fact that people need financial help and advice. And I think Scott can provide elements of that. If you are looking at putting towards a plan, a lot of what you touched on, Scott, the normal individual who goes out there day to day is not going to be able to do. Set up offsets account, learn how to save, even in terms of planning forward and building in order to buy another property. That needs 6 or 12 months in preparation. You don't just turn up tomorrow and go, right, I want to buy another property. So all of this stuff, and we recommend all of our clients to get some advice and to find someone that you can partner with to give you that advice. So hopefully Scott or anyone in that industry can help, but 100%. We will send everyone a summary of the presentation with Scott's details as well. And hopefully we can help you on your journey. Other than that, thanks everyone for attending, and we will hopefully catch up with you next time. Thanks.